Good afternoon, everyone. Merry Christmas. Welcome back to the last week in markets of 2024. Rather than just review the week past, we're going to take a wider lens with my colleague Sebastian Mackay from the investment team here, and we're going to reflect on the last 12 months over the next 10 minutes for you. It's been an extraordinary year for markets. There's been positive returns for almost every asset class, be it traditional equities, bonds, but also alternatives such as gold and Bitcoin. And we really should reflect on all of that. So Seb, welcome. Let's go back 12 months and reflect on bond markets first and really what was priced 12 months ago relative to what we have actually delivered today.
Yeah, so we've seen a significant pricing out of interest rate cuts that were expected a year ago. So looking at the US, at this time last year, interest rates were expected to be cut to 3.75%. After the cut that we saw yesterday from the Fed, interest rates have ended the year at 4.5%, so a significant increase from where was expected a year ago. In the UK, even more significant. So interest rates this time last year were expected to be cut to 3.5% by the end of this year, but they've actually ended up over 100 basis points higher than that.
So really markets were expecting, in particular in the UK, a substantial reduction from over 5% to below 4%, but we've really actually ended much higher than that. What I reflect on is actually inflation probably has fallen more in the UK, certainly headline inflation than perhaps even the Bank of England could have hoped for, certainly through the middle of the year. But fewer interest rates have come through, whereas we know that in the US inflation actually fell less than we all thought, particularly the Federal Reserve, but they've actually probably cut more than we would have thought for what inflation did. So how do we rationalise perhaps the bias to cut more in the US, whereas in the UK with the slower growth momentum here, there was fewer interest rate cuts?
I suppose one thing is that the US was starting from a slightly higher level in the first place. And I think in the UK in particular, although, as you say, inflation has fallen more than they expected, and actually growth has been a bit weaker than economists had expected in the UK, the Bank of England has been just very cautious in cutting interest rates, I think precisely because they were scarred by the severity of the inflation shock that we saw in 21-22. And I think the criticism of the Bank of England that they were slow to react in raising interest rates in response to that inflation shock has kind of hit home.
And I guess this feeds into your concept that you've spoken about with us on desk, is that this is very much a cycle of lags, whereas we would have expected interest rates to go higher earlier. They didn't. We would have expected perhaps interest rates to come down lower earlier, but they haven't. And so we're still feeding through that cycle of unusual lags in the economy.
I think market expectations this time last year were definitely guilty of applying old rules of thumb from previous cycles, and this cycle has taught us that it's completely different to the cycles that we've seen.
So that's a great segue into the 12 months ahead now, where they're actually following the Federal Reserve this week. There actually isn't that much price for interest rate markets for really the UK or the US. There's certainly a lot priced in the Eurozone, but the US and the UK, very different picture 12 months ahead, again, compared to where we were a year ago.
Yeah, and I think what we've learned over the last year, particularly for the US, is that the economy and also the equity market has been able to handle much higher interest rates than we'd had expected. A number of reasons for this, and we've spoken about it in previous podcasts, but I think one of the factors is that because of the size of government debt, higher interest rates actually mean quite large interest payments from the government to companies and households.
To savers, really, yes.
So that's actually had a positive impact on some households and companies, those who hold a lot of assets, interest-bearing assets. So the kind of previous, as I say, those kind of rules of thumb that we'd applied from previous interest rate hiking cycles haven't really applied this time.
Yeah, and if we reflect really on, away from the bond market, it's been a terrific year for global equity markets. So even in the UK, we were up close to 10% prior to the Federal Reserve meeting. Stock market in the US up over 20%. Global equities up over 20% in sterling terms. We've had great breadth in factors and sectors. We covered this really in a podcast with colleague Chris Leyland earlier in the week. But the optimism we had at the start of the year that we would see a very strong year for equities and that they would feed through into breadth, it wouldn't just be the US, has largely come through, albeit it has been the US which has led.
Yeah. I guess there's a number of things. There's the kind of once in a generation potential productivity enhancing AI developments. Just the strength of underlying earnings has just been remarkable through the year. So that, you know, although equities have done very well this year, it hasn't really been on stretching valuations or solely on stretching valuations. It has been also driven by earnings, the strength of earnings. And I suppose the other aspect is just how supportive fiscal policy has been, particularly in the US this year and is expected to be next year.
I would say, I guess if you could go back in a time machine 2 years to central bankers at the end of 2022 and say that 2 years now, inflation, if we think of the Bank of England, inflation will fall from over 10% to below 3%.
Yeah.
Job creation will actually continue. You'll have more people in the economy. They would probably not believe you that would be a remarkable outcome, because inflation has never fallen by this much in the last 70 years without there being a recession. So, and the equity market reflects that, where it's just renewed optimism, always 1 year ahead.
Yeah.
So it's been a positive return from bond markets this year. It's been an incredible year for equity returns, but we've also seen alternatives such as gold and Bitcoin have remarkable years. Now, gold has done very well prior to Trump, and Bitcoin has done exceptionally well post-President Trump being elected. So let's focus in on Bitcoin first, and it's somewhat of an unusual asset class. How do we contextualise how Bitcoin is reacting post-Trump?
I'm not a crypto bro, as they're known, so I can't really claim to have any great insight on this. But I guess one of the key reasons might be that a more relaxed regulatory environment.
It's now a regulatory asset, isn't it? It's not an inflation asset. It never really did have sort of credible inflation protection characteristics. It's more been something very uncorrelated or unusual, and it's possibly now more about the idea that Trump very much favours tech oligarchs, and that deregulation and potentially some form of attempted reserve asset involving Bitcoin could potentially benefit the asset class next year.
And actually, the strength of cryptocurrencies post the election, or from around that time, has kind of coincided actually with a bit of a weakness for the gold price. So I think to some extent cryptocurrencies are being seen as an alternative to gold.
So it's very much been politics which has influenced Bitcoin, and possibly politics which had influenced gold over the last 2 years in terms of the quantum of buying by large supranationals such as sovereign wealth funds, mainly China. So it's been, again, not so much as an inflation hedge, but maybe attempting to diversify away from pure dollar assets such as treasury bills.
Yeah, they hold an enormous amount of dollar reserves, and they've been diversifying those reserves into gold. I think the restrictions on Russia getting access to its dollar reserves following the invasion of Ukraine kind of tainted the status of the dollar as a reserve currency. And central banks around the world have been accumulating gold reserves, whereas previously they would have been accumulating dollar reserves since then. I think there's also been Chinese retail investment in gold. So the combination of a property slump in China and the equity market in China not really going anywhere for a long period of time has just led them to seek out alternative assets. And gold has been one of those.
Yeah, so it's just the quantum of buying by countries such as China has really put price pressure on the asset class. So it's been a really interesting year for all asset classes, remarkable returns way above expectations. And also we've had so many elections. We've had almost 3 billion people go to the polls in over 60 countries. Within the G20, We had almost 10 elections. Only 2 leaders were re-elected. Ramaphosa in South Africa, Modi in India. Both of those governments lost their majority. So it's really been a year of political change. But markets have actually done relatively well. So one of the reasons for our optimism ahead, I guess, is that with less political uncertainty for 2025, we can be just as optimistic perhaps as we were this year. And I guess Trump is more of a known this time round. We know that he's very transactional and that he'll probably want a series of incremental trade deals and wins with people like China in particular.
Yeah, I think some of the fears about tariffs, they're understandable, but yeah, they need to be seen as a negotiating tool. And, you know, he's simply trying to get the best outcome for America that he can, and using tools like tariffs as a negotiating tactic.
And we know that he is very sensitive to the direction of the stock market, so that he perhaps doesn't have any worries if the stock market falls, say, 5%, but if it was to fall 10%, then we know previously he's communicated on Twitter that he and his team are taking action. So he's certainly a growth-oriented leader. So that's all for our week in markets for the year. We'll be joining you and look forward to updating you again in the new year when the market cycle kicks off again. Thank you for all your participation and attendance over the year. We hope these seminars have been useful for you and that you've gained some insights into the context for markets. Please do enjoy your Christmas break, and we will catch up with you all in 2025. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.